Ever wondered how to make quick money with short sales? Allow me to enlighten you. Picture a bustling stock market, investors scrambling to buy shares at high prices, hoping they'll soar even higher. But what if I told you there's another side to this coin? A daring, somewhat controversial approach called short selling. Short selling, in the simplest terms, is a financial strategy where investors anticipate a stock's price to fall. They borrow shares, sell them, and aim to buy them back at a lower price. If successful, they return the shares and pocket the difference. Sounds intriguing, right? But hold your horses, it's not all sunshine and rainbows. This strategy carries significant risk and requires a keen understanding of market trends. However, when executed properly, the potential profits can be substantial. So how does one go about short selling? Strap in, we're diving deep into it. Short sales sounds simple, right? But the devil, as they say, is in the details. Now let's dive into the mechanics of short sales. The process begins with borrowing shares. Yes, you heard it right, borrowing. You borrow shares of a stock from your broker, promising to return them at a later date. It's like borrowing a cup of sugar from your neighbor, except in this case, the sugar is stock, and your neighbor is a broker. Once you've borrowed these shares, you sell them immediately at the current market price. Let's say you borrowed and sold 100 shares of a company at $50 each. You now have $5,000 in your pocket. But remember, those shares aren't really yours. You've borrowed them, and you need to return them. Here's where things get interesting. You're betting that the price of the stock will fall. If it does, you can buy back those 100 shares at a lower price. Let's say the price drops to $40 a share. You buy 100 shares for $4,000, return them to your broker, and voila, you've made a profit of $1,000. But what happens when things don't go as planned? Let's take a trip down memory lane to the GameStop saga. Hedge funds had shorted GameStop, expecting its stock price to fall, but instead a group of retail investors pushed the price up, leading to what's known as a short squeeze. The hedge funds had to buy back the shares at a much higher price, resulting in massive losses. It's a classic case of short sales gone wrong. The short sellers were caught in a bind, forced to buy back shares at sky-high prices to cover their positions, causing them to lose billions. Yes, that's billions with a B. It's a stark reminder that while the potential for profit is high, so too is the risk. So the mechanics of short sales involve a dance with the market, a gamble on falling prices, and an intricate intertwining of borrowing, selling, and buying back. Seems easy on paper, but remember, with great potential reward comes great risk. So you're ready to jump into the deep end? Hold your horses. Here are some things you need to consider before short selling. First and foremost, let's talk about the elephant in the room: risk. Short selling is like walking a tightrope without a safety net. You see, when you buy stocks conventionally, the most you can lose is the amount you've invested. But with short selling, your potential losses are, in theory, unlimited. If the stock price skyrockets, so does your loss. It's a high-stakes game, folks. Now let's get into the nitty-gritty. Before you even think about short selling, you need to have a solid grasp of market trends. Is the market bullish or bearish? Is the economy growing or slowing? These macroeconomic factors can greatly influence stock prices and your potential profits or losses. Then, there's the company itself. You need to scrutinize its performance. Are sales declining? Is the management team in turmoil? Are there legal or regulatory issues looming? Such factors can cause a stock's price to drop, making it a potential target for short selling. But don't stop there. Keep an eye on industry news as well. Disruptive technologies, new regulations, and changes in consumer behavior can all impact a company's prospects and its stock price. Remember, timing is everything. You need to short sell before the stock price drops, and then you need to buy back the stock at the right time, ideally when the price is at its lowest. This requires a keen eye for detail, fast decision-making, and a little bit of luck. And lastly, never short sell without a safety plan. Always have a stop-loss order in place to limit your potential losses. This is your safety net in the high-wire act of short selling. Short selling isn't for the faint-hearted. It requires a good understanding of the market, a keen eye for detail, and a stomach for risk. So, are you ready to take the plunge? Now, how do you make money with short sales? Let's dive into some strategies. The first strategy is timing the market. It's a bit of a tightrope walk, but when done right, it can yield significant profits. To do this, You need to identify when a stock is overvalued and likely to decline. This requires a deep understanding of market trends and economic indicators. Next up, thorough research. You need to dig deep into a company's financials, industry position, and the overall market sentiment. Look for red flags like declining earnings, heavy debt, or negative news coverage. Lastly, setting stop-loss orders. This is a safety net to protect you from major losses. If the stock price increases beyond your comfort zone, the stop-loss order automatically triggers a buy order to cover your short position. Remember, strategy is everything in short selling. Without it, you're just gambling. So, there you have it. The mysterious world of short sales unmasked. We've journeyed through the labyrinth of what short sales are, shedding light on this often misunderstood avenue of investing. We've dissected how they work, peeling back the layers to reveal the intricate mechanics that power this financial maneuver. We also took a deep dive into the risks involved, candidly addressing the potential pitfalls that can snare the unwary investor. Yet we also highlighted the potential rewards, demonstrating that with the right approach, short sales can be a profitable venture. Lastly, we explored strategies for success, providing you with a toolkit for short selling. From timing the market to understanding market trends and using stop orders, we've armed you with the knowledge to navigate the choppy waters of short sales. Remember, investing is not a get-rich-quick scheme, it's a marathon, not a sprint. So, invest wisely, and may the odds be ever in your favor. Before we wrap up this comprehensive exploration of short sales, we want to take a moment to thank you, our viewers, for your continued support and engagement. Your feedback and curiosity fuel our content, and we always strive to deliver the most informative and relevant financial insights. If this video has sparked your interest in short selling or broadened your understanding of it, we'd love to hear from you. Leave us a comment below to share your thoughts, experiences, or any questions you might have. We're here to foster a community of informed investors, so don't hesitate to join the conversation. Also, if you haven't done so already, hit that like button. It helps us to reach more people and spread the word about financial literacy. And if you're new to our channel or you've been watching without subscribing, now's the time to smash that subscribe button and turn on the notifications. By doing so, you'll be the first to know when we upload new content, ensuring you never miss out on any vital financial insights. Remember, knowledge is power, and in the world of investing, it can mean the difference between success and failure. That's all for today, folks. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more. Goodbye and happy investing.